doing DeFi, greatest in the world, and they finally about to see why. What you know about XRD? I'm smart money, I ain't never on a decline. What you know about NFTs? It's not just Ace, when you finally gonna realize you need scalability, need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline, building the future, I feel like a savage.
Hello and welcome. I am Piers, CEO of RDX Works, a core developer of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, the DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I have Willy Woo, managing partner at Crest and SyzCrest, a fund that builds financial products to give higher yield than T-bills by harvesting the volatility in crypto. Willy, welcome to the show.
Hey Piers, been a while. Great to be here.
It has. It's been a hot minute. I think you were our number one, you were our first guest of the DeFi Download. And this was actually a really interesting episode because the title of the episode was Bitcoin at $65,000 per Bitcoin. And this was your prediction of where Bitcoin was going to go. And at that point, I think we were trading probably around the 12,000 mark, maybe a little bit higher. And so 65,000 sounded crazy. It sounded like this number where I was just like, that sounds punchy. And then it turned out to be almost exactly right. I think you were within $3,000 of the top, and that was called 12 months before we actually topped. So it was pretty impressive call.
Yeah, I didn't even recall saying that. I was probably something I just took a stab at. I don't usually give price predictions, particularly back then, and so it's only since you reminded me of it now, Piers, that I guess that's what I said. But certainly, yeah. I was a lot more bullish once the bull market was underway. I had models around it, and I thought it would go a lot higher, and and that was also because I wrapped some models around it, and the markets did change quite markedly in that cycle. That was different from every other cycle. So, yeah, I think that had an impact, and I think, yeah, sure, that was like just a gut guess back before I had wrapped models around it, and it turned out to be more right than, what the models were saying. So yeah,
which is, I think, interesting, right? Like the frequency in which sort of like intuition can be correct is definitely higher than random chance, especially for people who spend most of their time looking at data and reading data. There's like what the data tells you, and then there's sort of, to some extent, what feels right as well. And I think that often as humans we go searching for. We can often end up in the bucket of going and searching for validation of our own thoughts rather than analysis of making decisions based on good analysis. And I think that this is constantly the battle, is like, is what I'm looking at actually correct, or am I either biased because I have made up my own mind of what number I want, or am I biased for some other reason, like because the models have been wrong in the past, so they may be wrong in the future? And when you look at sort of your history of building data tools to be able to understand markets better, where do you sit on that side of the fence? Like how much do you trust? How much do you put importance in your gut versus how much do you put in the data, and how do you stop counterintuitive results from being disregarded when you do that?
Yeah, it's a tough question, because when you build models, they're always going to be wrong. All models are wrong. They always break down. And honestly, I think, particularly short-term models, I think there's a lot of internal instinct and gut, just knowing those markets, and you'll the shorter term stuff is really, really very random, and it's much harder to wrap models around. And I would say that side of things, there's this models upon models upon models, and then they're all just modeling different dimensions, different views into the market. And it's not that the models are wrong; they're actually telling you exactly what you're told it to measure. It's just that it's only one part of you're looking at, and somewhere along the line, there's a decision to be made on which one has dominance. And I think that really comes down to, like some amount of instinct of what is driving the market. And sure, you can build a governing model on, the last past amount of time, like which model seems to be the more dominant one, whether you're measuring, for example, the futures market in some dimension of it, or the liquid to illiquid sort of movements on chain, or the spot movements. These are all different types of views into the market, and you can have endless models looking at it, behavioral models and whatnot. And you can either take a gut instinct on what's happening there, on which models apply, and then you could take the quantitative approach. Problem with the quantitative approach is you can look at the past and say, oh, look, we transitioned from this influence, like say the futures has been very dominant, now we're going to spot markets, so now we should allocate more to that driver of into the markets. But the thing is, the problem is you're looking in the past and you're taking a sample of the past. And so if you want, you can either just constantly look in the past and then project that forward, and it'll be wrong because it's not like that, it keeps changing. Or you can sort of get do the human approach and try and get a gut instinct, So I think it's a mix, really. I've done both. But I think also, it's hard to discount the instinct just from thin slicing the human side of it. So on the short term side of it, I think it's more like that. Longer term, probably less so.
As in, you think your instincts are less good over the long term, as in not yours specifically, but a person's instincts get less accurate the further out you look.
It's more that the further out you look, the clearer things become.
Right.
And you don't need to, even if you were to look at all these different models, looking at different views of it, they start to become. I think they all start to become very, very much the same as you zoom out. And so, you might look at on-chain models, you can look at future markets models, you can look at volatility models, and as you zoom out, you'll start to see that they all oscillate around these long-term cycles, and actually they all start to converge, and then you don't need to guess so much. You just put them all together, and this is what they say, and it's objectively the case, and all the short-term noise filters out. And it is that short-term noise that you're delving into. It looks like noise when you zoom out, but when you're trying to predict what happens tomorrow or next week or a few weeks from now, that actually is short-term noise, but it is actually not random noise. There's a particular
It reminds me of there's this wonderful economist called Robert Shiller. He created the Case-Shiller House Price Index, and he does this. He does economics, introduction to economics at Harvard, which is an open course that you can watch online. And he took one of the sort of key phrases that always comes back to me from his lectures is the markets are a random walk with an upward trend. And all of the statistical analysis that he's done across the markets basically show that it's statistically insignificant versus randomness. That there is no statistical significance but randomness in the market. The only thing you can say about it is over the long term it has an upwards trend.
Yeah, I've often said, there's the wisdom of crowds and effectively what do they call it, the efficient market. theory where
hypothesis. Yeah.
hypothesis that everything is priced in, it's perfectly pricing in the market. So I actually think
Yes.
long term that price discovery is very, very efficient. But
Yes.
in the short term, I've been known to say, this is back in 2018, 2019, is that the short-term price of Bitcoin is a random walk in the direction that liquidates the most traders on BitMEX. And that's actually the truth of it. Actually, you can actually you will find the price will move in the direction that will blow up the most traders, because that's actually the game that's been played in the short term, is to force the other side to lose so that you can get the payday. Most people think most people think trade. Yeah.
Is
Okay,
is the counter trade to that just then like looking at the funding rate and just doing the opposite of whatever's doing on BitMEX?
Yeah, well, it's no longer trade on BitMEX. It's a trade on multiple markets and these multiple positions in different markets. And usually Binance has got a huge role in it now.
Right.
And also, it's not always like, there's zones where everyone's on one side of the trade, and so there's so much money on it to liquidate them all. So you'll often find that that happens because it just can't. There's too much money to be made to blow them up, and so it's not actually random, but it looks random, and it's probably indistinguishable from randomness if you take it from a statistical viewpoint. I don't know, but when you start to look at, when we're standard deviations outside of the norm, where there's so much money to go and take it the other direction, that happens.
Right.
And then there's some times in the middle where, it could go either way because there's no coherency in the market and no one knows. But other times it becomes very, very certain, and it's certain to blow up the most people. But yeah, I agree with it. But I just say that randomness is statistically maybe true, but when you're playing the game of trading, and remember, people think that trading is like taking a bet in the direction of the price, the future price, short-term price. But that's not trading. Trading is actually the real players. The market's not uniform. The market is lumpy, and the really good players have a lot of capital. And so when they see all the small players going in one direction, they'll move it in the other. That's how markets work. So I used to say traders sit in this. We think traders sit in a stadium making bets on the gridiron game, American football. But actually, the real traders are on the field pushing for yards, bulls and bears, and they're moving it. And so that's the real game of trading in the short term. In the long term, it's like price discovery. At a certain point.
What do you think? What do you think the social value of trading is? Like if you strip it all away from the zero sum game of me versus you in the market and look at the externalities that are created by by trading, what would you say as someone who started off? And the reason I ask this question is I think there's an important sort of extra element to this in why crypto, a lot of the reasons that people got into crypto in the first place was a dissatisfaction in the way that the financial markets were run, essentially for insiders, the way that sort of the governments would come in and take away from the individual savers and put it into the pocket of bankers, and that casino that was set up for a small number of people to be able to bet very large amounts of money that wasn't even theirs, to be able to get gains to create this sort of wider divide in society. A lot of the stuff that I look at in crypto today feels like we're just recreating this but this time it's more of the geeks that are getting to do it. What would your thoughts on this be?
Yeah, I mean, at the most philosophical fundamental level, you need markets, right? You need a price on something, and you need it to be set by the free market. Like for like, let's say, look at Bitcoin. You know, it's 1 cent a coin. It's $30,000 a coin. That's if there was no price on it, there's no way you can transmit value. Therefore, it's useless as a monetary asset. And then the market needs to be solid. It needs to. If I want to sell my 1 Bitcoin for $30,000, I need to know that someone's going to pay it instantly within the next second. And if I wanted to sell 1,000 Bitcoins, I want to know that I can do that into a liquid market and it can be cashed out for something new. So that that I mean, that it's obviously, I think it's very obvious, but actually the nuance on that is maybe you don't see. It's like we think it's zero sum game, but this is the second order impact that these guys trying to take money off each other do, is that there's strong liquidity. There's multiple billions of dollars in Bitcoin traded every single day, and that means you, me, anyone else that wants to get in and out can instantly, and that's really important for any monetary asset. And then we get into this realm now that we've got this market, and you look deeper into it. Yeah, it's not a fair market. No markets are actually fair because the participants have different advantages. And if I come into the market and I hold, actually the number is around 10%. If I have enough assets of 10% of the market, of the spot market, generally I can push the price around pretty confidently wherever I want. And these whales
You mean
exist.
10% in the asset of the circulating supply of the asset plus 10% of the value of 10%. So as in, because you need both directions, right?
Yeah, I would say let's keep it simple. I found that if I had 10% of the daily volume in a particular market, and you can learn this
Yeah.
by trading tiny little altcoin markets, if you own 10% of the daily volume of that particular coin, and some coins are very illiquid, that means that you can control the price much easier. You can push it around, and you start to realize, if you sit in front of a screen and you're trading it for a month, right? You start to realize that you're not actually trading against a market. You realize, I think I'm trading with 6 other people, and they all roughly got the same kind of ammo as I do, and we can push it around within limits. And this is actually how, this is a great thing about altcoins, is that a teenager with not necessarily a lot of money can actually get into a tiny little market and spend enough hours to realize, holy moly, this is how a market works. It's not equal. And that's no different in the big leagues where you're trading TradFi with billions of dollars, and Bitcoin's no different either. You can actually see the bids and offers being moved on the exchanges with 1,000 Bitcoin ask or a bid, and it suddenly that scares the price in another direction. So these things happen, and so it's great. Crypto allows all of us to experience what it's like to be a whale. Just pick a tiny little coin, back in the day it was Poloniex. It was about, I don't know, 118 markets, and Bitcoin at the top, Ethereum down next, and then you keep going down, and it's like there's high stakes poker, that's Bitcoin, so is Ethereum, and then you just go down and it's like, I'm going to play that little noob game there, ranked 80th, right, on the, and then buy your tokens, and then you can trade it and you can get an advantage. And so you wouldn't experience that in any other type of TradFi. You would need,
Right.
you would need a lot of money and credibility. So there's that. There's the other thing is, in crypto we have every transaction being transparent. And so, I just came back from Singapore with the token 2049, and it is one of the things that I was presenting on chain. You could see every single transaction. Now there's a liquidity heat map. Here's the liquidation levels in the Aave lending pool. There's all of this DeFi data, and actually in TradFi that data is available. It's just not to us, right? It's
right.
BlackRock can buy it, Fidelity can buy it.
Right.
Robinhood.
Why Citadel provides
Exactly.
trade settlement to everyone is because it gives them the trade flow information. They know, like,
exactly. And so it is actually, again, like if you were to say the whale has the advantage, I have 10% of the daily traded volume. Well, these guys do have that, and now they have all the data on top of that to guarantee that their trade's going to be successful. And then on the DeFi world, at least everyone can see that. You may need to pay some subscription to a data provider that's collating all of those transactions and making sense of it, so you get a nice visual of the heat map or so forth.
Shout out to Glassnode and June Analytics on that front.
Yeah, exactly. It's just like there's a lot of democratization of that data, and that's not private. It's open networks. So there's that, and presumably we already see when these are what the whales are doing because they're transactionally very 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 transparent, and so there's a lot
do
of
you
work.
think that we should fight as an industry against privacy in DeFi? Like, do you think that that what is lost as a result of not having everything on chain, and therefore not only having pseudonymity, is the actual social gain of having everything transparent and open on Ledger means that the market overall can be fairer than it would be otherwise?
I mean, there's I think that we should have transactions that are private, but when we come down to a very very special type of transaction, and that's the transaction that is a trade on a decentralized exchange, I think that should be transparent, because if you look at all of the work that the SEC does, it's really about trying to break the advantage of whales, insiders, the people that can manipulate the markets. And so you do that through a process of disclosures. And right now, like, the SEC is hammering a lot of crypto projects, but not realizing, I don't think the policy really acknowledges that crypto has its own regulation framework, and that's called open ledger, right? There is disclosure, but at the fundamental protocol level. And I think that if you run a DEX and you want to prevent manipulation, you just keep the open disclosure side of the protocol. And I think once you pull it off and maybe want to keep your transaction private, because that's a human need. I don't want everyone in the world seeing what I spend my money on, right? It's just, I think that's important. I just don't think, so I think that we have like privacy, privacy in our own spending. That's different from a DEX where you're actually buying and selling at scale, buying and selling. I think there's a difference there.
Yeah, I tend to agree with you. I think that there are still a bunch of problems to sort out when you start to look at things like MEV and the fact that the mempool is open and therefore viewable means that you can, and the fact you can reorder blocks means that as a result of being able to see transactions, you can front run them. And so you have this secondary gain that then comes out as a result of the financial info, the openness of the ledger versus the ability to sort of like have a closed box of an exchange where I put my orders into the order book, but I don't see what order they came into the order book until it's executed in a way, like you would see on the NASDAQ. That's very difficult to achieve on public ledgers. So there are costs to transparency, but I think overall, I agree with you.
Yeah, I think it's solvable. I mean, the same MEV is also, that's prolific in the TradFi world. It's called high frequency trading, and it's basically another word for front running. All right, and through the course, there's been people that have built systems to help mitigate that, and I think that's a solvable problem too. So it's not solved now, but it is solvable, and it exists in the TradFi world, and the TradFi markets still work, so it's. Yeah, it's an issue, but it's not a primary issue. I think the main primary issue is manipulation of the markets by the whales. And yeah, you can solve that. And this is just beyond DeFi, right? It's like, we've got our NFT markets that is highly prone to manipulation. You mint your NFT and you buy it off yourself, and then you buy it off yourself again and again and again. I mean, that's the classic. So if you can solve these things and build into the protocol a way where we can easily see that, we've got pretty solid internal regulation.
Yeah, I think sort of like I love the saying, like, sunlight is the best disinfectant. Like, the transparency of a public ledger is something that I think does lead to at least a fairer dispersal of markets information. It doesn't solve for everything, because obviously different people have different information, and that by the time it's expressed on the market, it may be too late, which I think that is where a lot of things around like disclosures and insider trading and all of that kind of stuff is going to come into the market still, because I'm definitely in the. If you look at there's sort of three forms of the efficient markets hypothesis. There's the strong form, the weak form, and the sort of like the antithesis, as in markets are not efficient, right? So strong form states that all available information is incorporated into the price at any given point, meaning that you can never beat the market. If as soon as the information is known, the market price will change, as in like an everyday person can never beat the market. The weak form is that only publicly available information or publicly understood information is priced into the market, which means that if you can get an edge by through analysis that the market hasn't thought about, or through insider information, then you can get an advantage on the market. I generally subscribe to the weak form of the efficient markets hypothesis, which I think is why it's important you have rules around insider trading and disclosures and all this kind of stuff. And then sort of like markets aren't efficient. And I think the further down the market cap of any stock or share or token or whatever you go, the more that the market itself becomes illiquid, lightly traded, lumpy, and not really efficient at all. And that transparency on ledger is certainly helpful, but it's not everything. It still doesn't incorporate all of the behaviors that can cause manipulation, mispricing, sort of insider capture, whatever you want to call it.
Yeah, it's the strong form is, in my view, is just doesn't even work, because physics doesn't work like that. Because I think if you think of the markets as a superintelligence, it's a superhuman intelligence, right?
Right.
There's a lot of brains working on where it's priced at. So you think of the inefficient markets, these really low cap ones, you don't have the same number of human minds, or even actually in some cases machine learning, right, algorithms trying to price it, and so therefore it's inefficient. And then the soft form is, Even if if all the information that is public is perfectly communicated, right?
Mm,
Um, you're missing time. It's not going to hit all participants in the market
mm,
equally. So the people that can react the fastest, who are fully dedicated, probably have algorithms that are reading the SEC filings or whatever, the
mm,
blockchain, as it hits with the lowest latency. They will have more information than the next guy. So there's a
mm.
speed element, and clearly physics shows that one participant will beat the other because they're faster.
Right, right.
And so, yeah, there's definitely a way you can beat the market because the market is not all 100% normalized average Joe blogs. Some people
No,
are
but
very smart,
I,
some are very fast.
I think the weak form. I mean, either the strong or the weak form does hold an important lesson to the majority of people. Though, what you're right about. There is going to be a player who has a speed advantage in some way, but what most people can't fathom or don't realize is quite how much resource goes into creating that speed advantage, and quite how few
Yeah.
people actually have the opportunity to be that, to win that. Like if you think that you're going to get a speed advantage by just having like a simple ML algorithm running on your computer, you're wrong. Like you need to have optimized every single part of the information flow, your ability to analyze and your ability to respond to sort of fractions of seconds or less to be able to be even in with a chance of beating the market on a piece of information that comes in, which means I think that for all intents and purposes, sort of at least for the larger traded things where those players are actually involved, you can just say, most people can just say, if it's already known in a disclosure, if it's already like publicly out, that isn't where I'm going to get my alpha from. That isn't where I'm going to be able to work out how to get an advantage in working out what the value of something is, or be able to trade signals on.
Yeah, I agree with that. I mean, there's two advantages. One is better digest. Oh, there's three, right? Insider trading, better access to information no one has. There's the next one, which is better way of modeling the data in ways in which no one else can model that and digest it to come up with a price model. And the last one is being faster than everyone else, just sheer speed.
Mm-hmm.
That's where you get into like front running and all sorts of things. Like if you can react faster, so speed, smarts, and then sneaky smarts.
Yeah, this it goes back to the wonderful quote in what was it called? The Big Short. Was it The Big Short? I think it was The Big Short, where he said, "Be first, be smarter, or cheat."
Yeah, you're right. That's exactly this. Right? I don't recall that quote, but that's exactly it.
Right.
And yeah, this
And
is why hodling works, right? Going back to the Schiller,
right,
saying long term it goes up. Just sit
right.
on it.
It's a random walk with an upwards trend, and like ultimately, hodling, and I think this is why hodling is such a good strategy for most people, in that if you zoom out from the technical analysis and the volatility and the noise of a market, and instead just focus on the underlying fundamentals of a thing, the underlying fundamentals of a thing are often easier to reason about from a first principles point of view. And once you have believe that you've identified something that has strong underlying fundamentals, the next best thing is just then to buy it and hold it. At least that's the way I look at markets. Like I think trading, and I think technical analysis is the male equivalent of horoscopes. Like it generally speaking is. And I think what you said was really right, which is like, it's not that the model is wrong, it's just it doesn't have enough information in it. It's like it's telling you what you've asked it, but the questions aren't encompassing enough to actually be instructive for what is going to happen next, with any degree of repeatability or reliability. Feel free to
Yeah.
debate me on this, because I'm very happy to hear the other side.
I mean, this is an ongoing, endless debate. I would say, look, my day job is, I'm a fund manager, and we allocate to automated trading algorithms. So
Yep.
everything has statistical rigor, right? And yes, there are arbitrage trades which will always beat the market because they're seeing, if I do this trade, I will win. It's
Yes.
overpriced here,
I can
underpriced
see
here, I
the
will win.
price. Yeah, exactly.
Right,
Right. Yeah,
right.
sure.
So that's one
Right.
way, and then the other one is directional trading, and that one's really hard to get right. But you know what? There are a number of algorithms out there that they get it right, right? And I know one that there's a number. This is very popular in FX, which is you feed in the candles, the price over time, and then you tell it to recognize the particular trade setups. And these are technical patterns. Actually, all they're doing is trading technical patterns numerically, and then you give it a score of how reliable is it. How reliable is this pattern, and you based it to statistically on some measure, and you make the trade, and then you know that you might be wrong 40% of the time, maybe 55% of the time. You just got to kick yourself out of the trade if it's not going your way, and these systems work again and again and again. Part of it's risk management, a big part of it. The other bit is the patterns do actually show something inside. Like when a price pattern does something, plays a particular way, it is indicating to you the behavior of the market. Is the price is coming down, now it's gone flat, right? And so there's going to be a volatility squeeze. It's gone straight. What that means is there's a particular thing that's happening in the market. Like people are putting their lines in the sand around this price, and it's going sideways. Then you know that when it goes one way, it's going to break out massively because the other side's going to get trashed, and they've got to cover there. If they've gotten short, they've got to buy it back. And so if it goes the wrong way, they've got to add their power to the direction they bet it against as they lay down their position. So you get these squeezes. So that's one fundamental, but it's laid down in the price pattern. So I disagree that technical patterns don't matter. They very much are telling what traders are doing and subtly
So here's the
showing.
question though: do they matter enough? So like for the person, like you talked about the teenager in the bedroom, right? Who's a noob who's coming into this market. Should he spend all of his time looking at technical patterns, like drawing the I can't remember what they're called, like the regressions and the bull flags and the bell flags and all of the other stuff? Or should he spend his time learning the fundamentals of the market, learning the fundamentals of the players, and taking a longer term view on understanding the asset class that he's actually trading? Like what is the direction that kid should be taking, and why?
Well, if you're going to trade, you want to trade with all the available information that you want to learn the asset you're trading. So you need to know fundamentally what the heck are you trading. All right, are you trading crypto kitties? Are you trading tulips? Are you trading Pokemon cards? Or are you trading Bitcoin? These have it tells you something about how you should hold your position longer term, and then you should be learning technical patterns, you should be learning fundamentals, you should be learning all of it, and then find your strength in it, because it's a zero-sum game. In the short term, it's a zero-sum game. So you're just taking money off each other.
I
remember
this is where I personally, again, this is sort of very much personal stuff, but it's like I don't want to learn zero-sum games. I don't like, in many ways, as in, I have to understand them well enough to understand what the dynamics of them are. But I don't like spending time, the amount of time I see people spending on like technical analysis and trading charts that is essentially all of their free time, versus being able to build up a to educate themselves, to better themselves, to increase their understanding of something to the point where they're actually able to be productive in some way other than just guessing what the next random movement of the market is. Like those two things one feels like a
Yeah, I
bad
mean, this gets very, very philosophical, and we can be very you can be very like, rational about it. It's like we shouldn't be playing zero sum games, and we should be playing these games that are additive and compounding. We should all be playing compounding games, right?
right.
But the problem is life philosophically, life doesn't always work like that, right? There's going to be some kid that is just born to trade. And when I say born to trade, I mean they're winning. I mean, that's all they think about. That's the only thing that lights them up. And I say just go do it if that's the case. If you're trading to make some money because you're actually after the money, but you don't love the hunt of that zero sum game, then that's probably a bad idea. Go find some compounding game. But if you just can't wait to get out of bed and just do nothing but trade, and I posted on Twitter. I met this trader, and no one believed the story. He was kidnapped. I think he was a successful trader, and he climbed out the rear window, smashed the rear window, and ran for it. And these guys shot him. He was shot 9 times. He was just running away, and he survived. And in the ICU ward, he asked for his laptop, and then he started trading in the ICU. He was born to trade. That's what lights him up. It probably helped his recovery. He said he was bored as hell, and he was sitting there, and this is what lit him up. So he's one of the few that's a born trader. He doesn't sleep. He sleeps when the market sleeps. He'll go hours, days without sleeping until the market sleeps, and then he loves it. It's the only thing he lives for. So I wouldn't tell that person go play compounding games. All right. And actually, he's contributing to the market at some level. He's adding liquidity, he's adding efficiency, and all of civilization, our over 100 trillion of world GDP is based on markets working and being efficient. So you can look at it like that as well. I just watched Gran Turismo. And that was like the parent telling the kid, don't be like me. Look, I work on the railways, and stop playing that game. And he just didn't want to do anything other than race cars, and that was his only access to it by playing this game. And he became a professional race car driver. And you just don't know where it ends up at, right? And I think, I personally did this the startup back in my past, as a while back, and I thought I needed to do something useful for society. This is like nth startup, not like my early startups where I was just like couldn't wait to get out of bed to do this thing. I was so excited. I was like, we need to solve this problem because no one's going to solve it. And I realized. I thought that was purpose. Purpose was doing something useful in society. It's not. Purpose is, you really feel purpose is when you wake up out and there's nothing you want to do except that thing. Like that trader, that's his purpose. It just lights him up. And I think that's all we need to shoot for. We can get philosophical about compounding games or zero sum games, but ultimately this is life philosophy, I think. So
I think that's a really important point. Is like purpose is an internal function, not an external function. And I think you can find purpose in many things, but it has to be purposeful for you as well as purposeful. Like it has to be purposeful for you. I'm actually just going to stop it at that. It has to be purposeful for you. For it to add meaning to your life. And I think a lot of people search for purpose externally, and when they try and find that purpose as a result of what they think purpose looks like, but for like purpose can be anything as long as it gets you up in the morning and makes you want to go and do that thing, and that's the thing that you want to go and do, and that brings you satisfaction in going and doing it better every day.
Yeah, and it's just, I think I'd summarize it as purpose is not a rational thing. We used to call it external. It's not a rational thing. Purpose isn't like, oh, you're doing something and it helps, that widget helps other people. That's a rational thing. Purpose is an energy equation. When you do this thing, you get more energy from it. It lights you up. You want to do more of it, and it's this ascending cycle of getting more and more amped over the thing you're doing. It's an energy equation. It's nothing rational. Steve Jobs was like that. Apparently, he was like, he's dying, and it started like it's in his biography, the Isaac Walterson biography. As he started talking about the iPhone, near his deathbed, he started to pick up. He started to animate. He started to live again, and so that's purpose.
Yeah, and also like the other thing I thought was really interesting about his biography is that while he was in the hospital, he was giving critical feedback on the hospital equipment from a UX perspective. Like, exactly. And like, yeah. And like in his plane, when he had his plane done, he couldn't just like get his own private jet. Like he had to go and actually obsess over every single detail about how the plane was from a usability point of view. Same with his boat, same with his house, like everything. His obsession was about that it should just work properly. It should just be brilliant. It should be brilliant. Like, why would it be anything less?
Exactly. And this is where we'd segue into Radix, right? Because I've met you and Dan, and what was that? It was 2017, and I know when did this start? 2014. It's like, was it 2014 or even 2013?
2013 is when Dan started it. I joined in 2017. Okay. Yeah.
So you're working on this project for 10 years, right? 10 years till full mainnet launch just this week, right? And if you don't have purpose, you don't have that energy equation driving you forward, you're not going to last for 10 years, Right. So yeah, that would be the segue to Radix, I would say.
Yeah, I think you're absolutely right. And I think that.
Yeah, it's like, what is it? Like people overestimate what can be done in the short term, and long term very much underestimate just how big something can get. And actually, if you're doing this kind of purpose where the energy equation works, it's the only way to get doing something for 10 years, 20 years, 30 years. How many years was these all these large companies running for? They're all multiple decades before they hit massive scale.
Yeah. And this is the reason I love compounding games, right? Like compounding games can the initial gains can be small, but if you are persistent and consistent and determined, and you have a wider vision that you're aiming towards, but you also are able to break that vision down into steps along the path that are feasible and achievable and executable on, right? Like that you don't like vision without the interim milestones is unachievable. But like if you can play that game of each step that you need to go along the way towards what you're trying to do, you wake up in 10 years and suddenly you have the tech stack that Radix is. And that was not something that someone was able to wake up and do in a month or a year or 3 years or 5 years. It's something that has taken very large number of people a very long period of time. But that overarching vision has meant that compounding game has started now to get an incredible amount of energy behind it, because that the the obsession of Dan and then the later obsession of myself, which, our obsessions definitely complement each other. Dan's from a sort of fundamental tech point of view, me from like a user experience, usability point of view, have created this huge system that could only have been created over a multi-year process of obsession, dedication, and focus. And yeah, that's I suppose at base why I think compounding games overall are more satisfying. But I mean, that's because I'm a compounding game player. Like that's what it comes down to.
Yeah, this is like version 4, right? I think there was like many ways that were tried, and sometimes many years of investment into it, and then it needed to change. So yeah, hats off on that one.
But each of those iterations taught us something, right? Each of those iterations meant that we were able to make the next one better.
Yeah. Yet you wouldn't have done it if you were after the short-term game.
Right.
Yeah.
Right.
Anyway.
Yeah. And we certainly wouldn't have done it if we thought it was zero sum. Right? Like the opportunity for Web3 crypto public ledgers, to me isn't that it eats traditional finance. The opportunity for me for this space is that it increases the capabilities of humanity. And like that
right.
may
Yep. No, sorry. Carry on.
That was it.
I'm agreeing with it. It's just like it was an absolute goal, not a I want to beat what's out there.
Right.
Yeah. Right. Yeah, I mean, yeah. Well, I think what struck me was the integrity I saw in the team. I mean, I don't want to turn this into a shill Radix podcast or anything, but like, I don't think I certainly wouldn't be on this podcast if I didn't see integrity in the team. I think that there was times where there were easy wins where the network wasn't ready and it could have been launched into it could have been launched into two bull markets. The 2017 bull market, it could have been launched into, actually. Could have been launched into the last bull market, rushed in with the last iteration that was scaling like crazy, but had a flaw under some edge case under a security audit based on secondary markets. You didn't launch it. It didn't take the potentially billions, certainly hundreds of millions on as a payday, because you stuck to the integrity of your vision over the quick payday. I don't think many people realize that.
I mean, when we were in the 2017 bull market, like I put up Tempo, the consensus algorithm had the white paper had recently gone out. Like scaling solutions was like the main narrative of the entire crypto space in the layer one game. It's sort of around the time of EOS, around the time of all of those projects that were able to take billions off the table, and we put a simple like sign up process to see what kind of interest we'd have in market, and I think in like a couple of months time we had over $500 million worth of interest registered to sort of buy the token of Radix, and we opted not to go to market. And I think that again this comes down to this whole question of what game are you playing, and being very clear with yourself what game you're playing. Because I do think that's the only way to, like, effecting true change requires a degree of activation energy that most people are unwilling to play to. and you kind of have to keep that solely in view, because if you take the short term wins at the wrong time, you actually make it impossible for you to reach the long term wins. And that's been the basis of every one of our decisions that we've made.
Yeah, certainly. If you'd launched on the earlier iterations, it's very hard to make any changes once these things launch. They're blockchains.
Yep.
They're very hard. I mean,
Yep.
yeah, we know that.
And it's very hard to change a reputation, right? Once
Yeah.
something launches in the wrong way.
In the tech space, it's usually quicker to launch the next thing and start from scratch.
Right.
Yeah.
I'm gonna round it out now, Willy. It's been such a pleasure having you on. Thank you for your always fascinating discussions. I really hope we get to do this again. Maybe in 2 years' time, we can check in again on where things are, and we can shill Radix again together.
Yeah, I look forward to it in 2 years. It's a long time from now in this space we're in. But look forward to it, Piers. Thanks for having me.
Need more utility, then you better call on these guys. I'm going radical, I'm going Radix, I'm going radical, I'm going Radix. Hyperspeed DeFi, never on a decline. Building the future, I feel like a savage.